Every algorithmic trading strategy experiences losing streaks. No system charts a perfectly straight line up, and encountering market dips is a guaranteed part of the trading process. Managing that inevitable risk is the entire foundation of the Otoalgo platform. Step 1 to deploying a strategy safely is knowing exactly how much cash you need to survive those losing streaks. By the end of this video, you will know how to identify a strategy's maximum drawdown and how to use our risk-free profit metric to calculate the exact reserve capital your account requires. Systematic trading relies on identifying and planning for these worst-case scenarios before the first trade is ever placed. Let's start with the basics. A drawdown is the drop in a portfolio's value from its highest peak down to its subsequent lowest valley before it reaches a new high. On a performance chart, visualize this distinct drop from a peak down to a deep valley. The duration falling to that bottom is the time to reach. Climbing out of the valley to return to that original peak's value is your time for recovery. Tracking these timeframes is critical. Surviving a market dip requires capital, but it also requires the patience to weather the weeks or months it takes for the system to recover. Over years of backtesting, a strategy will experience many small dips, but the absolute largest single drop across the entire timeline is your maximum drawdown, or MDD. This specific MDD metric mathematically defines the historical worst-case scenario. It tells you exactly what your account must be prepared to survive. Standard platforms usually calculate drawdowns by looking at the absolute cash lost. Otoalgo uses a much more precise method. Instead of raw cash, Otoalgo calculates the ratio of the decreasing cash against the actual margin you put at risk for that specific trade. This generates a true daily P&L percentage. This chart shows the cumulative daily P&L percentage line graph at the top of the interface. By using the margin-based daily percentage, Otoalgo plots your true performance to accurately find those peak-to-valley drops. The platform logs the primary MDD and the top 5 historical worst-case scenarios your strategy has faced. Below the percentages, Otoalgo displays the exact date ranges for those drops, along with the average, minimum, and maximum days it took to reach and recover from them. By anchoring the drawdown to the actual margin risked rather than an abstract cash value, you get an accurate picture of your true proportional risk. Once you know your MDD, you can calculate your reserve money. This is the extra cash you must keep in your account to feed your margin during a severe drawdown without getting liquidated. Let's run the math. Say you risk a $100,000 margin on a strategy with a historical 50% maximum drawdown. That means you can face a $50,000 deficit during a bad streak. To run this safely, you need the $100,000 for the margin plus the $50,000 in reserve, totaling $150,000 in required account capital. Now, let's analyze the returns. Imagine this same strategy yields an impressive 600% net P&L over its lifespan. Traditional platforms would claim you made a 600% return on your $100,000 margin. But because you had to tie up $150,000 to safely survive the drawdown, your true return on locked capital is lower. This table displays the risk and reward scorecard. Otoalgo calculates risk-free profit by dividing the total profit by the actual total capital required. In our example, the full $150,000. Looking at the net P&L percent next to the risk-free profit shows you the difference between raw profit and your realistic, risk-adjusted profit. This metric acts as your shield against over-leveraging, ensuring you evaluate strategies based on the actual money required to survive the worst days. You now know how to read peak-to-valley drawdowns, how margin-based MDD works, and how to calculate the exact reserve capital you need. With this data, you can backtest and deploy automated robots with absolute confidence in your true capital requirements and your realistic returns. Open the Strategy Builder on Otoalgo and check your own scorecards to see your strategy's risk-free profit in action. Systematic trading requires defining risk and planning for it, which allows the system to execute the math exactly as designed.